Not all investments are created equal. This definitive ranking reveals every major investment type, from the worst money traps to the best wealth-building strategies. Options. An option is a contract that gives you the right, but not the obligation, to buy or sell an asset at a specific price for a limited time. For example, you could buy a contract giving you the option to purchase a stock at $100 per share over the next month. If the stock price rises to $120, your option becomes valuable. Options are complex and extremely risky, as their value is dependent on price movements within a specific time frame. They can be used to speculate on market direction or to protect against losses, but they require serious knowledge and are definitely not for beginners. Traders often use options as part of sophisticated strategies, balancing potential rewards with significant risks, making education, discipline, and risk management absolutely essential before venturing into this advanced area of investing. Cryptocurrency. Cryptocurrency is a new kind of digital money that is not controlled by any central bank or government. It exists only on the internet, secured by a technology called blockchain. Investing in cryptos like Bitcoin or Ethereum is highly speculative. The potential for massive returns exists, but so does the potential for massive losses, and the entire market is still developing. You could see extreme gains in a short period, or you could lose your entire investment just as quickly. This is an investment class for those with a high risk tolerance, using money they can truly afford to lose. It requires constant monitoring, strong discipline, and a willingness to face extreme volatility without letting emotions dictate your decisions. Collectibles. Collectibles covers everything from fine art and vintage cars to rare wines and luxury watches. Investing in collectibles means you are betting that an item's cultural value and rarity will make it more desirable and therefore more valuable over time. The market can be unpredictable, and an item value is often subjective and dependent on finding the right buyer. However, for those with expertise and passion, it is a unique way to diversify. It turns your hobby into a potential asset, blending what you love with your portfolio strategy. Collectibles demand patience, research, and timing, but for knowledgeable investors, they can provide both personal enjoyment and financial opportunity. As with all investments, risks remain, but a carefully chosen piece can appreciate significantly, offering a hedge against inflation while adding individuality and prestige to your holdings. Private equity. Private equity funds pool money from accredited, meaning very wealthy, investors to buy ownership stakes in these private companies. The objective is to help them grow and become more profitable before selling that stake for a large return down the road. This is an exclusive, high-risk, high-reward corner of the market, typically inaccessible to the average retail investor, that focuses on identifying and developing the major companies of the future. These investments often involve long holding periods, complex negotiations, and hands-on involvement, but the payoff can be extraordinary for those willing to commit both time and capital. Beyond financial gain, private equity often drives innovation, restructures industries, and creates opportunities for global expansion, making it a powerful force in shaping the broader economic landscape for decades to come. Commodities, gold, oil, wheat, coffee, these are all commodities, and you can invest in them. Investing in a commodity like gold is often seen as a defensive strategy, a way to protect your wealth when the economy is uncertain. It has historically held its value when traditional currencies or markets falter. You can buy physical commodities, or you can invest in funds that track their prices. It is a way to diversify beyond just stocks and bonds by investing in the tangible goods our global economy runs on. Commodities also respond to factors like supply shortages, geopolitical events, and weather conditions, making them behave differently from traditional assets. Including them in a portfolio can reduce risk, increase resilience, and create valuable protection against unexpected market shocks. Certificates of deposit. A certificate of deposit is a savings product offered by banks. You deposit a fixed amount of money for a set term, ranging from months to years, and, in return, the bank pays a guaranteed interest rate. Withdrawing early usually results in penalties. While the returns are modest, the investment is incredibly safe, especially when you use FDIC-insured banks and stay within their coverage limits. Unlike more volatile investments, certificates of deposit give you a clear timeline and predictable outcome, making them attractive to conservative investors who value certainty. A certificate of deposit will not generate significant wealth, but it is a secure place to hold funds for short-term goals or money you need to protect. Money market accounts. Money market accounts is a type of deposit account that offers higher interest rates than a typical savings account and often comes with a debit card or check writing privileges. Your money is invested in very safe, short-term government securities. It offers a high degree of safety and is easy to access, but your money is still earning a more competitive interest rate than it would in a basic account. It is the perfect blend of safety and liquidity for your emergency fund. While these accounts are not designed for aggressive growth, they provide peace of mind by keeping your money secure, accessible, and working harder than a standard savings account, making them an excellent option for cautious investors seeking balance. Annuities. An annuity is a contract you make with an insurance company. You give them a lump sum of money or a series of payments, and in return, they agree to send you a regular payment for a set number of years or even for the rest of your life. Its purpose is to provide a predictable, reliable source of cash flow in your later years. The terms can be complex and the fees can be high, so you have to read the fine print carefully. But for those who prioritize the security of a dependable income in retirement, an annuity can be a powerful tool. It adds stability to your financial plan and ensures peace of mind during uncertain market conditions. Ultimately, annuities can complement pensions, Social Security, and savings to create a well-rounded retirement strategy. Bonds. With a bond, you are essentially acting as a lender. A government or a corporation needs to raise money for a project, so they issue bonds. You purchase a bond, effectively giving them a loan. In return, they provide a formal agreement to pay you back the principal in full on a specific date with regular interest payments along the way. That is a bond. It is generally considered much safer than stocks because the returns are far more predictable. The growth potential is not as dramatic, but you have a much clearer idea of the return you will receive and when you will get it. For investors who value stability over explosive growth, bonds are an instrument for a reliable income stream and greater portfolio stability. Real estate. A home for your family or a rental to generate income is direct real estate investing, where you purchase a physical property. It is an appealing asset because it is tangible. But what if you do not have a large down payment or the desire to be a landlord? There is another way. A real estate investment trust, or REIT. A REIT is a company that owns and operates income-producing properties. Buying shares in a REIT allows you to invest in a large portfolio of real estate, apartments, office buildings, and shopping malls, without the high capital outlay or management responsibilities. Additionally, many REITs pay regular dividends, giving investors consistent income, along with the potential for long-term growth as property values appreciate and rental demand continues to rise across different sectors. Mutual funds. A mutual fund is a professionally managed investment that pools money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. Instead of you researching and buying dozens of different securities, a fund manager does it for you. This structure instantly spreads your risk across many different investments, so you are not overexposed to the performance of any single one. Mutual funds are also available in many varieties, from conservative income funds to aggressive growth funds, giving you the flexibility to choose according to your financial goals. It is a practical option for beginners who want instant diversification and professional management without having to do all the research themselves. Exchange-traded funds. Exchange-traded funds, or ETFs, offer similar benefits to mutual funds, but with a key difference in how they are traded. Just like a mutual fund, an ETF is a collection of investments, such as stocks or bonds, that provides diversification in a single product. The primary distinction is that ETFs are traded on stock exchanges throughout the day, just like individual stocks. This means their price is constantly changing during market hours. They often feature lower management fees and give you the same powerful diversification as mutual funds, but with the added flexibility of being able to buy or sell them at any time when the market is open. ETFs are widely available, highly accessible, and can fit into nearly any investment strategy with ease. Index funds. An index fund is a type of mutual fund, or ETF, that does not try to beat the market by picking winners. Instead, it simply aims to match the performance of a specific market index, like the S&P 500. Because no active manager is making strategic decisions and frequent trades, the management fees are usually extremely low. It is the ultimate set-it-and-forget-it strategy, perfect for anyone who believes in the long-term growth of the market as a whole. You will not get returns that dramatically outperform the market, but you can expect steady performance that mirrors it. Over time, this consistency helps investors build wealth steadily, avoid unnecessary risks, and focus on long-term financial goals rather than chasing short-term market swings or speculative investments. Stocks. When you buy a stock, also known as a share or equity, you are buying a small piece of ownership in a publicly traded company, whether it is a technology giant or a major retail chain. If the company performs well and its value grows, the value of your ownership stake can go up. You might also receive a portion of the company's profits, which is paid out as a dividend. Stocks are a classic high-risk, high-reward asset. Their values can be volatile, experiencing significant increases and sharp declines, but the long-term potential for growth can be substantial if you are patient. At its heart, buying a stock means you are investing in a company's future success, and if you are right, you get to share in the rewards. The core and satellite strategy. The core and satellite strategy is a popular method to combine assets into a coherent portfolio. This approach involves dividing your portfolio into two parts. Your core is the large, stable foundation, usually made of low-cost index funds or exchange-traded funds. This part makes up the bulk of your portfolio and is designed to provide reliable, long-term market growth. Then, you add your satellites. These are smaller, targeted investments in riskier assets with the potential for higher returns, such as individual stocks, crypto, or other alternatives. This strategy gives you a solid foundation while still allowing you to take calculated risks to boost your overall returns. It balances safety with growth, helping investors achieve diversification, control, and flexibility within one clear, disciplined investment framework.